Welcome to the latest episode of the JO Huddle. Today we're joined for the first time on the Huddle by Matt Davey, Tekkorp Digital CEO and former NYX Gaming CEO. Hi Matt, thank you for taking the time to speak with us again.
Great to catch up, Tim.
Absolutely, yeah. It's great to have you on. And I say again because it's the first time we've appeared on the Huddle, but we of course recently spoke for the CEO special for Gambling Insider magazine.
That's right. No, you guys put together a great article. I enjoyed it.
Oh, thanks. We appreciate the feedback. And yeah, it was great to feature you there as well. To start off with today, I think it would be great if you could tell our viewers about your current ventures, Tekkorp Digital and Tekkorp Capital, and what it is specifically they do at the moment.
Yeah, so I had the luck and pleasure of building a business called NYX Gaming Group over a 15-year period, which culminated in the sale to Scientific Games back in January 2018. And so fast forward to January 2019, I fully integrated the company within Scientific Games and then set up my own investment vehicle. The view being, how do we deploy capital into this expanding online sports betting and iGaming market with a particular focus to the dynamics of what's happening here in the US. And that's been a fascinating experience. Along the way, we also saw the big arbitrage between the private-based investment type opportunities versus public investment opportunities. And so to help kind of capture that and bridge this gap, we launched a special purpose acquisition company called Tekkorp Digital Acquisition Corp. And we raised $250 million in trust, and we've been actively in the market now, talking to private companies about going public. Our focus there is in the $1 to $2 billion type enterprise valuation range, and we've had a marvelous time going through that process now. So we've been actively investing. We've also, through Tekkorp Capital, which is my private vehicle, made a number of investments, more in the growth equity side of things in both public and private companies. And it's just been incredible to look at how many entrepreneurs are coming into the market with great creative ideas, looking to solve real problems that we have here in the US and internationally.
Yeah, certainly. So it's a busy time, certainly for you guys and for the online US industry overall. When we spoke for the CEO special, you told us any firms you're looking to invest in must have some kind of nexus with the US market. And as you just said, you kind of described sort of briefly the profile of firm you're looking at. Can you maybe expand a little bit on the type of profile of company you kind of might already be working with or maybe looking to work with in the future?
Yeah, so the nexus to the US is particularly relevant for our public vehicle, the special purpose acquisition company. The thinking there is, there are a large number of fast-growing and highly innovative gaming operators and suppliers in the global market. Not all of those would make sense in terms of bringing public here in the US. What the US market is looking for is, you might have great economics and a great business, and you might have a great team, but why is it relevant to me? Why should I, as a US investor, be thinking about investing in your business? And so we are looking specifically for companies that do meet those growth metrics, that have great management, great technology, great intellectual property, but also have a really clear reason as to why they would need to be public on a US exchange. And typically that relates to actually running operations here in the US. The good news is the US market is probably the most attractive emerging market in the world for sports betting operators and suppliers and iGaming operators, etc. So we don't have much of a challenge in finding that nexus, but it's important to us that it logically makes sense to put this kind of private company on a US exchange. We're listed on NASDAQ, and so our investors, while they can invest in international companies, they'll be looking for what the US story is, which we obviously don't think is a problem given it's got such a great growth story behind it.
Absolutely, yeah. That profile you just kind of described, would you say that's something kind of all US investors are looking for? And how different is kind of maybe the profile of a firm investors are looking at for the US compared to other markets in the world?
Yeah, so I think when we look at just the companies themselves, what we're seeing are two different types of businesses really here in the US market. We're seeing homegrown opportunities where entrepreneurial businesses or great technology companies that have been in and around the space are now looking to really tap into the sports betting market or the iGaming market, either through the supply of data and analytics or core software, or even get into the operations side. But we're also seeing a lot of the more mature operators out of the European markets that that have built their businesses over the last 20 years or so look to expand into the US market and bring their technology and operations and skill set and experience into this market. So we're seeing a range of different types of businesses. The ones that probably don't make as much sense, for instance, let's say you're focused purely on the African subcontinent, for instance, you're not as relevant to the US market as perhaps a European business that has set up operations in 10 states here in the US. So there are some limits to that, but by and large, most internationally scaled operators will have some form of presence here in the US, and we're certainly finding some very strong nexuses and narratives behind the US expansion.
Yeah, and going back to your previous answer where you mentioned kind of going public, because that is obviously a key opportunity for a number of firms at the moment, and obviously has been in the past. Given, as you said, Tekkorp Digital is a special purpose acquisition company, a SPAC, which is quite a common term these days, but perhaps in the gaming industry a couple of years back it wasn't so common. For the CEO special, we spoke about the benefits of a SPAC against an IPO. Is it fair to say a SPAC is ideal for a fast-growing technological company with a lot of future value, whereas an IPO perhaps, and this is sort of my thought, so please do tell me if I'm wrong, is better suited for maybe more legacy firms?
Yeah, there's an interesting quirk in the listing process. So if you're a private company and you want to go public in the US, you've got three real direct routes. You've got an IPO, you can do a direct listing, or you can merge into a SPAC. The IPO, the main difference in the IPO and the SPAC is that in an IPO, you can only talk about past revenue performance. You can't describe future revenue performance. And we find that most investors, while they appreciate the past and it gives you some indication as to the quality of the business, they're really focused on what the future growth rate looks like, particularly in an environment where interest rates are almost at zero. Investors are really looking for high quality businesses with a rapid growth rate and a great trajectory. So the SPAC process allows companies to merge into the SPAC vehicle and describe in very clear terms what their growth trajectory looks like. And we're seeing projections go out 3 to 5 years so that investors get a good sense as to how this business is developing from where it is today to where it can go in the future. So we find that component allows investors to make more informed decisions. The second component to a SPAC is typically alongside the actual investment of the funds inside the SPAC. So in our SPAC, for instance, we have 250 million. Quite often you'll find a PIPE investment go alongside in parallel. And that's where you bring additional investors in that put up some additional capital. And that could be, another 100 million, 250 million, 500 million, for instance. Those investors have qualified the target as well. They've gone and kicked the tires. They've come to terms with the valuation and they've effectively underwritten that valuation. And so that gives a secondary indication to public investors that this business has the quality that they're looking for. So we find the SPAC structure allows investors to make more informed decisions and get more comfort with what the future prospects of that company is. And ultimately, that's what all investing is. It's about identifying the future growth rate and the quality of that business as it grows, not really in terms of what it's done in the past.
In your view, does that make a SPAC perhaps kind of the optimum solution universally, or are there still kind of examples and situations where you think a SPAC is better suited for this company, but that company in this situation, one of the other options?
Yeah, I think it's not the vehicle for every business. I think it particularly suits fast-growing companies that know that the majority of their growth is in the future, and that they have perhaps a limited past in terms of US-driven results. The US market itself, just specifically talking about the sports and iGaming market, lends itself to companies looking for a SPAC type environment because the whole industry itself really is only 2 years old. And we're finding new states opening up quarter by quarter. So the market is rapidly changing, and that obviously is putting a fire under the growth rates. And because of that, we're finding companies that have no operating history in the US, for instance, 2 years ago, now have, a trajectory of, 200, 300, 400 million of revenue coming from the market. So this industry in particular, within the current state of the US market, lends itself specifically to companies that would find SPACs highly attractive. So we think that's a great dynamic for us.
Sure, yeah, that definitely answers the question, makes a lot of sense. And as you've mentioned, there's been plenty of going on from an investment point of view and from an M&A point of view in gaming in recent years. DraftKings obviously went public via a SPAC. We had FanDuel being acquired by Flutter, Caesars purchasing William Hill, and a bit more speculative, but there's, Las Vegas Sands perhaps looking at online now, and people suggesting against speculation that perhaps 888 could be a good target for them. Without asking you obviously to comment on specific deals like that or rumors, how do you currently assess the makeup of the online market right now in the US, and kind of the top players are not winners and losers, but how it's forming?
I think it, to be honest, a really fascinating time. Yeah, intellectually, it's quite the process. I find it very stimulating to think through the possible permutations and combinations. So just to paint the context for you, we have an industry that didn't exist basically 2 years ago. We now have an opportunity on a state-by-state rollout where we have north of 20 states that have licensed for online gaming and sports betting. And we think that market, effectively drives an industry from zero to $1 billion in gross gaming revenue today to potentially $20 billion in gross gaming revenue over the next, 4 or 5 years. So the market's rapidly growing, and that allows for a whole number of entrants into the market. Operators which have a different bent, a different nuance to their approach to go to market, a different brand cachet, for instance, and a different approach to how they want to run their business. And the whole ecosystem feeds a whole range of different businesses within that. You've got geolocation businesses, you've got KYC businesses, you've got platform and content, along with sports betting operators that are specialists in in-game betting, for instance, versus pre-game betting. So there's a whole range within inside that ecosystem. And because the market's growing so rapidly, it supports a range of businesses. And then the public markets are also prepared to fund those businesses, knowing that the outcome is uncertain, but that the future looks pretty rosy given the size of the market. So you've got that expansion, you've got all of the different businesses that can fit within that ecosystem. But at the same time, we know that all online e-commerce oriented companies lend themselves to scale. We know that the world doesn't need to have 500 different Amazons, for instance. There are 3 or 4 companies in the world that effectively offer the same kind of service that Amazon does. So we know that these businesses ultimately will consolidate. We know they consolidate because the larger you are, the more powerful you can be, the bigger your marketing budget can be, the greater you can control your advertising across a nationwide environment. So we know that this expansion, this massive proliferation of businesses ultimately consolidates. And the funny thing is, you're not going to see it in just one straight curve. You're going to see it cycle through that. So you're going to see large operators consolidate smaller operators right now in the next year or two, and you'll continue to see that in the next 2 or 3 decades. So we're watching that happen at the moment. In this case, we've seen 2 examples of US dominant operators look to acquire European partners. But my guess is we'll also see some of the larger kind of digital-only US operators also start to tuck in some of the smaller operators, if only for market access, as well as some technology and operational skill sets. So this is very dynamic. It's fun to watch. It's great as an intellectual process to think through. And I think it will stay in a very dynamic environment for the next couple of years.
Certainly, as you say, it's absolutely fascinating. And you've actually touched on a question I was going to ask later. So I think it's the perfect time to jump to that one, and then I'll rearrange your order a little bit. Something we spoke about during the CEO special was retail versus digital, and you said you can see retail very much becoming the secondary channel in the long term, and digital gaming becoming the primary channel. And what you just mentioned there, I was going to ask, long term, would you say that shifts the balance of power within the industry, or will land-based chains still be kind of the leading players because they've either partnered with or bought the major online businesses? And you you started talking about that there. So yeah, I'll be keen to get your thoughts on that question.
Yeah, I think it's a great question. I think there's a few things. Let's unpack within that. So first of all, my operating thesis is the digital channel is a higher quality, better experience than the retail channel. It's not for every product, but for the gaming, for the sports betting and iGaming industry, I think it is. I just think that if you deliver something over the mobile phone or iPad, for instance, the experience itself actually is better than what you can get going to a physical casino. Not for every product, but in the whole. So, and not all products lend themselves to that, but just so happens we're in an industry where you can digitize the product and the actual experience, the convenience and the quality of what you can get is better. So that's step one, right? I think digital wins over retail from experience. Step two, though, is historically within the gaming industry, the land-based gaming operators have had stronger influences over regulations, as well as they are bigger contributors typically in terms of employment. And that matters a lot to the policymakers within each state. So they hold a strong political sway, and I don't see that changing. We've seen that scenario play out in Australia, the UK, Europe, continental Europe, and I think we're seeing it play out here in the US as well. In some states, for instance, you cannot get a license for an online digital offering. It's retail only. And I think that there are some strong reasons from the local regulators and policymakers to kind of protect the larger employers. So I think land-based operators will have significant political clout, and I think that won't change. But that said, we know that the digital suppliers and operators will have a more efficient business model. They can grow more rapidly and they can be ultimately more profitable. So I think from an economic perspective, you'll find some of the larger pure play digital operators may be the ones that consume the land-based operators, as opposed to the other way around. Right now, we're seeing the land-based operators, do most of the consumption in that respect. So it's dynamic again, and it's nuanced. And I think we have to separate between the quality of delivering the value proposition, the entertainment proposition, which I think lends itself to digital, versus the reality of where each company sits within each state.
Absolutely, yeah, very interesting again, fascinating, like you say. How do you balance achieving the scale you're talking about versus perhaps operating maybe more independently and having advantages where you're not necessarily under the umbrella of a larger organization? Or so to add on to that question, based on what you're saying, actually, will everyone kind of be consolidated anyway in the future?
Look, I think in the iGaming space, you can have a whole range of operators. The iGaming model has an inbuilt profit margin, which lends itself to a whole range of different sized operators performing really well and having a great business. Sports betting doesn't. Sports betting is different. Sports betting, you typically find the top 3 or 4 operators within any kind of core defined market segment as being profitable, and everybody else underneath not being profitable. And that's really a function of the marketing and how specifically tied in sports wagering is to each market segment. And so in the US, perhaps I think of it in regions, maybe super regions. You've got East Coast, Central and West Coast, and maybe there's some sub-regions within that. And we might find half a dozen or so leaders within each of those regions that are profitable. But we will find in markets like that, there'll be 30 or 40 operators, and if 6 are profitable, you're going to have 24 or so that will be losing money. So I think you'll see consolidation driven by that. And I think you'll see a limited number of winners. And then typically if you are a market leader in your region, you probably have a good bench to go and acquire market leaders in the other regions. So I think then you'll see national type consolidation as well, just because of those functions.
Absolutely, yeah. I have one more sort of topic to pitch at you, but just before I ask that, last question, I'd like to thank you for your analysis so far, because I think from what we've discussed, it's fair to say that the US sports betting market has certainly lived up to being one of the hottest topics in the industry. So as I say, my final sort of question was, what's your take on how online sports betting and the market is currently shaping and performing with so many new states recently launching? Do you think it's still, as you say, it's only 2 years old or so? Is it too early to tell long-term winners, or do you think there's a lot of market share being gained by the kind of first mover advantage at the moment?
Look, I think that's a wonderful question. I think it's very easy for people to overestimate the strength of the current market leaders, and it's very easy for people to underestimate how that can change over a period of 5 or 10 years. Experience tells us that the markets take decades to evolve, and that the leadership can change quite dramatically over that period of time. The US is further complicated by the highly fragmented nature of the markets. So you have very different rule sets, very different market incumbents within each of the states. So again, I think there's a lot of settling out there. I don't think we have seen the top six today that will be the top six in 10 years from now. I think there'll be significant changes, if only from mergers and acquisitions, but I think we'll see new market entrants that will also really move the dial. So I think it's very early days. In terms of the adoption of sports betting, certainly Americans have taken to it with quite a degree of force. But there's still a huge market out there that still doesn't understand what's available, either thinks online gaming and sports betting is illegal, doesn't know how to install apps on their phones, haven't used their credit cards, debit cards, for instance, to fund these things. So there's an enormous education phase as well. And I think that's going to be a tailwind with all operators in the US market. There were statistics in New Jersey, for instance, after the market was operational for 3 or 4 years, where 60-70% of citizens there still felt online gaming was illegal, even though it's been legitimately licensed by the Department of Gaming Enforcement for many years there. So there's this huge educational phase to go through. And I think, even though we're seeing great numbers being posted today, that's nothing compared to what we'll see in 5 or 10 years from now as the overall market grows and matures into this position. So leadership, I think, will change. I think what we're seeing right now is a great start. And certainly you've got some really strong contenders between MGM and DraftKings and the Flutter team with FanDuel, et cetera. I mean, they're amazing, powerful businesses, but I also think we'll see additional entrants come through with very strong and forceful positions that they can establish in the marketplace.
So we're to watch out for a lot of growth and a lot of change.
Absolutely. Bang on.
Can't wait to see the results of what's going to happen. There's you've made it sound fascinating, but not for nothing. It is a very interesting topic at the moment. So Matt, I'd like to thank you for taking the time to give us your thoughts on this, and I'm sure our viewers will find it very, very interesting.
Thanks, Tim. Great to catch up.
No problem. Thanks again. For more from Matt Davey, you can find his in-depth CEO special interview on his life and career in gaming on GamblingInsider.com in the January-February edition of Gambling Insider magazine.